Hello traders, welcome back to our Smart Money Concept course. We have already covered market structure and structure within structure. We have covered break of market structure and change of character. And today we'll be talking about liquidity and imbalances of fair value gaps. Let's get to it. When we talk about liquidity, liquidity is just like what fuel is to the car, right? Now, for the car to be able to move and to go everywhere, it must have fuel, right? Like in the market, for the market to move and go anywhere it wants to go to, the market must be fueled by liquidity. Right here in front of you, I have a bullish market and a bearish market. Now, in a market, whichever market it may be, liquidity is mostly found in areas with equal highs or equal lows, right? And you can see here also marked equal highs and equal lows. Some people will call them M patterns or W patterns, right? In a bullish market like this one right here, when the market is in this type of a range, you find that there is two types of traders who want to buy here, right? They want to buy because obviously we are in a bullish structure, right? Now what happens is that we have retail traders who are saying they want to buy here, and we have breakout traders saying they want to sell here, right? Now what is going to happen is that because they know that if it's a range, the market will have to come and continue ranging like this, right? So they want to buy the low of the range and make money from there. Those are retail traders. Those are the people who trade support and resistance, right? Now a retail trader will say, okay, I will buy here, and after buying here, will say I will buy here, and after buying here, the market will have to go up in my favor, right? Now they will buy here and put their stop losses below the equal lows, right? Now this is what happens. This is what happens just after they've bought. Now because wherever they put their stop losses, that is where liquidity is mostly found, right? After they have bought, the market will now come down, go and fetch the liquidity here, because the market has to be fueled, right? Just like a car, it will go and fetch the liquidity. While it is fetching liquidity, it's hitting their stop losses, and then the market will go up. This is what other people call stop hunt, right? But this is not a stop hunt. This is not their stops being hunted, right? It's just that the market needs this liquidity that is down here so that it can be fueled to wherever it wants to go, right? It's just unfortunate that their stop losses were down here and their stop losses were hit, because those stop losses, when they are put here, they are the ones creating that area of liquidity. After hitting your stop loss, you'll see the stop loss, you'll see that the market continues to the upside. All right, now we have another type of trader who will be here in the market. That other type of trader is a breakout trader. The breakout trader will be saying that the market is breaking here, seeing this move that goes below this equal low. The breakout trader will say the market is broken here and it's time for me to go into the market with a sell, because with this breakout here, he expects the market to go all the way down there, right? Now when the breakout trader sees that, he will go in with a sell, and his sell position will be placed here with stop losses up there, and he will be saying that I'll put my stop loss there, and the market will go in my favor, right? Now, but what happens here is that when the market gets here, it goes there and is in profit for a few minutes, and he will be very excited, saying that the position is about to go down. But before he knows it, this position goes and it hits his stop loss, because the market has been fueled. The market is done fueling, right here, and this position will go up there, hit its stop loss, and it will continue the other direction, right? So those are the two types of traders who will be looking to enter in this market. And as retail traders, as smart money concept traders, we are not losing our money here because we trade with the guys who move these markets like they are moving. All right, we do not lose money right in these situations. It's only retail traders and breakout traders who will lose their money there. It is the same situation when we come to this bearish market here. They have their stop losses in this area that I'm highlighting, and the retail traders are saying they want to sell here, and the market will just come and fuel itself here in this liquidity where their stop losses are, and in the process of fueling up, it will hit their stop losses and it will go down. And in this case, retail traders will be buying and their stop losses will be somewhere here, and the market will be in profit for them for a few minutes, and the market will change direction and hit their stop losses, right? Now let's look at the chart, and I will show you real life examples. Now here we are on a Euro US dollar 4 hours chart, and we have a market that is creating areas of equal high, and we'll just watch to see what happens in that area. Maybe we'll be able to use there we go. Now you see that the market is creating this area right here. This area seems to be a very good area we can work with. See, we'll call this area an area of liquidity, right? Because in this zone right here, this is a high resistance zone, right? You can see that the market is being resisted every time it comes into this zone. Let us mark that zone. All right, we'll call this zone a high resistance zone right here, and I'm sure that if we continue to pull this zone backwards, this zone will probably be in a yes, you see the market came and it supported this zone there. If we continue to pull this zone backwards, let's see what we will find. Perfect. You can see that this zone was once respected as support before, and it supported the market all the way there, and you can see this is the same zone, that was respected here, finally broken here, and it is now creating this area of support here, of resistance here, right? And now above this area right here, this is where we find liquidity, right? And now because there's a lot of liquidity here, we expect the market to come and grab this liquidity right here on top. We expect the market to come and tap this area right here. Let's change the color so that, yes, let's make it green. So we expect the market to come and grab liquidity here. The market should enter here before it continues downwards. Right now, let's play it out and see what happens. Now remember that when the market returns here, the retail traders will be waiting to sell, right? Okay. Now yes, look at this now. So at the point where the market was returning here, the retail traders were saying we are going to sell in this area. Why? Because when the market comes to this area, all the time this area is respected and the market goes down. Now in this area means someone was selling here when this candle was still here, and now this candle went out and their stop loss was hit right in this zone here. And now let's see, the market is collecting the fuel right here in this zone that I drew here, because there's liquidity here, and let's see what happens after that. Now look at this. After the market came here and collected its fuel, it was fueled enough because of the liquidity found above this area, and after being fueled, the market then immediately just went down. You see, this is like that structure that I showed you, that when there is resistance trade, support and resistance traders taking their positions here and putting stop losses here, they create a level of high liquidity, and when the market comes back there, it will just come here and fuel itself with this liquidity and then move down, right? But right here, when the market broke this area here and closed this candle above, we have other traders who are breakout traders who took positions here, saying that the market is now going up because it broke this area of strong resistance. Right now, after taking that position here, their stop losses will be placed somewhere below this line, and after placing their stop losses, they will expect the market to go up. And what does the market do? The market comes and hits their stop losses and go all the way down. Right, that is how liquidity works, and I believe that this is a good enough example for you guys to be able to see that in areas of liquidity, the market will go there to fuel itself before it goes to the direction that it wants to go to, because the market needs fuel just like the car needs fuel. Right, next up, let's go to imbalance. Now, imbalance refers to a position where the players in the market did not get equal opportunities. Right, we have two players in the market. We have the buyers and the sellers. The buyers are the ones who say the market is bullish and they want to go bullish with it. The sellers are those who say that the market is bearish and we want to go bearish with it. Now, an area of imbalance is an area where we see that not both players were given an opportunity, and we see that because we have a candle that is so big like this one right now. You see, this candle is so big and we do not have any other candle wicks covering this whole candle. Right now, we call this an imbalance candle. Right, and this gap between this wick of this candle and the wick of this candle right here is called a fair value gap. Now I will explain that in a different way. Now let's say you are in a market and you have three candles. You are seeing three candles just like these three candles right here. Right, you have candle number 1, candle number 2, and candle number 3. Right, now when you have these three candles and you look at candle number 1 and the wick of that candle is not covering the body of candle number 2, and the wick of candle number 3 is not covering the body of candle number 2 as well, and what you have now between candle number 1 and candle number 3 is this massive gap that is not being covered by any wick. Right, that is referred to as an imbalance, and when we draw a box between it, this box become our fair value gap. Right, it simply means that in this scenario we had a lot of sellers in the market and the buyers were not getting any opportunities. Right, now we have also in a bullish candle, this will be an example of what an imbalance candle looks like. Right, in this case you can see that we have this candle right here, which is a bullish candle, and you see candle number 1 and candle number 3, their wicks are not covering the entire body of candle number 2. Now when we draw a box from this wick here to that wick there, what we have in between there is called a fair value gap. Now in this scenario, this simply means that we were having a lot of buyers and the sellers were not given opportunity to enter the market. That is why we have this big candle here like this, and we call this an imbalance or a fair value gap. Now I believe that that's enough for your understanding right now. I will explain what we use these fair value gaps for in other videos when we add to the knowledge. and I believe we will do that in the next video, where we'll start taking trades and combining some of the information that we have learned in this video. Now here's an example of a candle where the gap is fair, or where the market gave opportunities to both sellers and buyers, right? You can see candle number 1, candle number 2, and candle number 3. This candle number 1 and number 2 have completely covered candle number 2's body, right? There is clear evidence that both the buyer and the seller got an opportunity to enter in the market. Here is another example right here. This is a very good one. You see, we have this candle number 1 here, we have candle number 2 which is bullish, and candle number 3 which is bearish. You know, this candle right here does not have any gap between the wicks of candle number 1 and candle number 2, so it shows you that there is sufficiency in the market, right? This market is sufficient because between this candle and this candle, the buyers and the sellers both had an opportunity to participate in this market, right? So in this market, you can see right here with candle number 1 here, candle number 2, and candle number 3 right here, that we have this imbalance here because the sellers and the buyers did not get equal opportunities. Here it's only the buyers who got an opportunity because of this fair value gap that we have here between candle number 3 and candle number 2, right? So I just thought I should add that extra information and explanation right there, so that maybe for those who did not understand, they'll be able to understand it if I continue showing examples, right? Thank you very much for watching this video. I'll leave this video here, and we will see next week. On next video we will be talking about order blocks, and we will also talk about something that I have called flip zones, and we will talk about fair value gaps as well. Thank you very much. If you have any questions, please feel free to write your questions on the comment section below, and I will address your questions as soon as I see them. Thank you very much.